So in this video, I wanted to share another strategy with you guys here that is quite interesting for smaller accounts, but also for bigger accounts. I'm usually trading this strategy with around 10% of my capital. And I think this is a sweet spot as the strategy brings some more risk. However, you're able to minimize that risk if you have a great position sizing. And I am speaking about buying leaps. So this channel is all about the premium cycle where we are selling cash secured puts and covered calls. So we sell a cash secured put, we collect the premium, possibly we enter a position, so we buy 100 shares. And if not, we are going to continue selling cash secured puts. If we are assigned, we switch to the upside and we sell covered calls. Sounds pretty simple. It's a great strategy. I am using this strategy and generating my monthly income with this strategy. And if done correctly, if you do it on the right stocks at the right time, it is a very conservative strategy. And I have a full course inside my community where I am explaining this strategy in detail so you guys understand the mechanics of the premium cycle. And I'm also sharing my live trades there. But I'm also trading a different strategy, which is buying leaps options. So I am buying call leap options. A leap is a long-term equity anticipation security, which basically means that your leap option that you're going to buy is going to expire 1 year out or even more. If that is the case, this is going to be considered a leap. And as we know, options are traded in a 100 pack. So on a cash secured put, we are committing ourselves to possibly buy 100 shares of a company. So you will need the capital to buy these 100 shares. If we speak about this example, because I just bought a leap option on Microsoft here, if we speak about this example here, if you want to sell a cash secured put here, for example, at the $380 strike, you're going to need $38,000 in capital to place this cash secured put. Because if you end up being assigned, you are going to buy 100 shares at a $380 strike. With a leap option, that is totally different because we are buying that leap option and that leap option gives us a leverage, meaning we are controlling 100 shares, but we are only paying a fraction of the price that 100 shares would cost. So in this specific example, as you guys can see on the screenshot, if I would have bought 100 shares of Microsoft, I would have paid around $38,000. But since I bought the leap, which is going to expire in 2028, so nearly 2 years out, I only paid $12,600 for this leap, and that is going to give me a leverage on this position because I am participating on the capital appreciation if the Microsoft share is going to rise. And I didn't put down the full capital. I only put down $12,600, and this gives me a leverage on this position. We can calculate it right here. So if I would have bought 100 shares at the market, either way I'm going to buy it at the market price or with a cash secured put, I'm going to put down $38,000. But in my case, I only put down $12,600. So if we make the calculation here, $38,000 divided by $12,600, which I paid for the leap option, I have a leverage of 3. And also we have to calculate in our delta. My option in this case had a delta of 0.8. That means if the stock price of Microsoft rises $1, I am going to participate 80 cents because I have a delta of 0.8. So we are going to have to multiply that leverage times 0.8, which leaves me with a leverage of 2.4 on that leaps option. And also on this strategy, your risk is defined because your maximum loss is going to be the price that you paid for this Leaps option, which is $12,600. That is the maximum risk which I can lose in this trade. If I would have bought 100 shares for $38,000, my maximum risk is to lose the $38,000 if Microsoft share price goes to zero, which is very unlikely. And this strategy is a higher risk because if you are in an unrealized loss on Microsoft, you can just sit it out. You can sit on your hands and wait until the stock price recovers eventually. And then, if you decide so, you can sell your shares and still profit from that position. The Leaps option is a little bit different because the Leaps option has an expiration date, which means that it is going to lose value over time until expiration date. So the stock price has to rise during that time so you can sell your Leaps option for a profit. Best case for a higher profit. And that's why generally this strategy brings more risk, because if the stock price doesn't rise, you can lose all your money you paid for that Leaps option. But if you do it on the right stock at the right moment, you can generate massive capital gains with this strategy, which makes it even more interesting for a smaller account, because this allows you to grow a smaller account much bigger, much faster. So if we look on the chart here on Microsoft, this is why I made the decision to buy the Leaps option right now, because yesterday Microsoft was trading around $383. And as you guys can see, I have marked here in blue my support line, meaning I believe that Microsoft is not going to drop lower than this line here, which is at 355. And up here, the red line is going to be my first resistance line. So as we can see, Microsoft has a hard time to break through this level somewhere around 450 up here. But as we can see, I bought the Leaps option like right here when the stock price was sitting at $383. And we can see that we have less risk to the downside here. There's less space to the downside than there is potential upwards momentum to the upside. And I believe that a price of $450 to $460 is very, very reasonable until mid-2028 for Microsoft. I even see a possibility that Microsoft is going to achieve new all-time highs. So it can also exceed the 500 mark somewhere up here. Their analysts are very bullish on Microsoft. The average price is going to be around $530 on Microsoft. But as you guys can see, if we talk about risk reward, we have less room to the downside than we have to the upside, because if we look down, we only have from where I bought it around $30 to the downside, but to the upside we have more like $60 in a quite conservative scenario. So my Leaps is going to benefit from that upwards momentum with a massive leverage of 2.4, meaning for every percent that the stock is going to rise, I'm going to benefit from that. I can multiply that by 2.4, and that is going to be my percentage gain on this Leaps option. And there's also many other stocks out there where you can buy Leaps for $1,000, $2,000 or $3,000, and you can have the same effect just like on this Microsoft Leaps. So as you guys can see, this strategy is quite suitable for smaller accounts. And if this is interesting to you, if the premium cycle and Leaps and the options market is interesting to you, and you want to generate a safe passive income, and you have already saved up $10,000 or even more, then click the link in my bio, watch my full course on the premium cycle, join my community. We have a live chat going on there where I am sharing all of my live trades, so you guys can benefit from that. So click the link in my bio, and I'm going to see you guys there.